In the late 1990s, America kind of lost its mind. This new thing called the internet was promising to change absolutely everything. And for a few wild years, it really felt like anyone with a .com in their company name was on a fast track to becoming a billionaire. It was a total gold rush, a massive party that felt like it would never, ever end. But of course it did. And the story of how it all came crashing down holds some pretty crucial lessons for anyone watching the markets today. This quote from punk rocker Johnny Rotten just nails the feeling after the music stopped, right? It perfectly sets the stage for what we're about to dive into, a story of incredible hopes, unbelievable wealth, and the brutal hangover that followed when everyone remembered that reality has rules. So, how did this whole thing even start? The dot-com bubble wasn't just about a bunch of cool new websites. No, it was a perfect storm. It was the collision of two massive world-changing forces, a brand new medium and a tidal wave of brand new money. Let's dig into how those two pieces came together. It's actually pretty easy to forget that the internet started as the exact opposite of a business venture. It began as ARPANET, a government project. For decades, it was this obscure tool that only scientists really used. But then, in 1993, boom, everything changed. The Mosaic browser came out, and for the very first time, you could see pictures next to the text. Suddenly, the web was colorful, it was user-friendly, it was cool. By 1995, it was fully privatized, and the starting gun for a massive commercial land rush had been fired. Okay, so you've got this incredible new technology, but that's only half the story. You need fuel to start a speculative fire, right? Well, that fuel came from this huge shift happening in the world of finance. All of a sudden, millions of regular Americans, people who had never even thought about the stock market before, were becoming investors. And just think about the scale of this for a second. By the year 2000, there was a staggering $1.7 trillion sitting in 401k retirement plans. That's an unprecedented mountain of cash, and a lot of it was being managed by people who were totally new to investing. And they were all looking for that next big thing to bet on. And boy, did the internet look like a sure winner. Just look at the shift. In only 15 years, we went from a country where the stock market was basically a rich person's game to one where almost half the population was in on the action. This new wave of investors was so enthusiastic, so optimistic, and, here's the key part, they were a lot less experienced with the booms and, more importantly, the busts of Wall Street. So you've got the tech, you've got the money. Now all you need is a spark, something to light the fuse and turn all this excitement into a full-blown mania. And that spark came on one single day in August 1995 with one absolutely spectacular IPO. The company was Netscape. They made the Navigator browser, which really was the tool that opened up the web for millions of people. But look at the numbers here. The company was barely a year and a half old, and it was losing money. By any traditional way of looking at it, this was a super risky bet. But the market, it didn't care about tradition, not one bit. On its very first day of trading, Netscape's stock shot up 153%. A company that was losing money was suddenly valued at over $1 billion. This just sent a massive shockwave through the entire investing world. And just like that, Netscape basically wrote the dot-com playbook. The message it sent to Silicon Valley and Wall Street was loud and clear. Profits? A long history of success? Forget about it. All you needed was a good idea, a .com in your name, and a way to tap into this flood of public money. The gold rush was officially on. What happened next was just pure euphoria. For the next few years, logic was basically thrown out the window. The media acted like cheerleaders. Economists were declaring a new economy, where the old rules just didn't apply. And company valuations soared to levels that were completely, totally disconnected from reality. This right here is the psychological engine that kept the whole bubble inflating. People weren't stupid. They knew the prices were absurd. They knew a company with zero profits wasn't really worth billions. But it didn't matter because they all believed they could just sell their shares to someone else, a greater fool, for an even higher price before the whole house of cards came tumbling down. Okay, if you want to see just how detached from reality the market got, check this out. In 1999, Priceline.com, a company that lost over $100 million, was worth more on the stock market than 3 of the country's biggest airlines combined. We're talking about real companies with real planes and actual profits. And Wall Street was saying they were worth less than a money-losing website. It was crazy. And the media, well, they weren't just reporting the story, they were actively fueling it. Pundits and magazines were all pushing this idea of a new economy. The internet, they argued, had fundamentally changed the laws of economics. This wasn't a bubble, you see. It was a permanent new age of prosperity. And that narrative made it so much easier for people to justify paying insane prices for these stocks. Even the insiders knew what was really going on. They understood that the public wasn't investing based on some careful, sober analysis. No, they were buying lottery tickets. They were totally willing to lose money on 19 different .coms for that one tiny, tiny chance that the 20th one would be the next Yahoo or the next Amazon. But here's the thing about parties that are fueled by euphoria and greater fools. They can't last forever. By early 2000, the cracks were starting to show. And when that bubble finally burst, the collapse was every bit as swift and brutal as the rise had been euphoric. Looking back now, the warning signs were crystal clear. The Fed started raising interest rates, making it more expensive to borrow money. A major financial magazine, Barron's, published this deep dive showing exactly how fast these .coms were burning through all their cash with no way to ever make a profit. But the market, just high on its own momentum, ignored it all. It just plugged its ears and kept dancing. And then, the floor just fell out. The speed of it was staggering. After peaking on March 10, 2000, the tech-heavy Nasdaq index just went into a total freefall. By the end of that year, it had lost half its value. A year after that, it was down by 2/3. Trillions of dollars in wealth just vanished into thin air. The crash left everyone just dazed, confused, and asking this one simple question. How could so many smart people, investors, journalists, economists, get so completely swept up in the mania and get it so spectacularly wrong? If you sift through the wreckage of companies like Pets.com or Webvan, you start to see some really powerful lessons about the difference between a revolutionary technology and a sustainable business. Lessons that are just as important today as they were back then. Ultimately, the biggest lesson was pretty simple. The internet didn't rewrite the fundamental laws of business. You still need a path to actually making money. Getting a bunch of eyeballs on your website or having mindshare was totally meaningless if you couldn't eventually make more money than you spent. The old laws of economics, it turns out, had only been suspended. They hadn't been repealed. But here's the thing. It wasn't all for nothing. All those trillions of dollars that got invested during the boom, as misguided as a lot of it was, that money paid to lay the fiber optic cables and build the server farms that created the high-speed internet we all rely on today. And out of those ashes rose the survivors, companies like Amazon and eBay that proved you could build real, lasting businesses online. And that really brings us to our final thought. Think about it. A story about a world-changing new technology, combined with a flood of cheap money and a massive wave of public speculation, where people are more worried about missing out than they are about the actual risks. Does any of that sound familiar? History has a funny way of repeating itself. The real question is, can we spot the patterns when they show up again?